Good morning from our global headquarters in New York. I'm Menace Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set your agenda.
A double whammy for American tech. Apple and Google lose in separate legal fights against the EU Court of Justice. But it's a win for the banks, a dramatic retreat for capital required for the biggest U.S. banks. Going head-to-head, the nation counts down to the first debate between VP Harris and former President Trump tonight in Philadelphia. Good morning, Manus.
Danny, good morning. These markets, so much for buy the dip. It didn't last very long. We're flat on the S&P 500, 54.74. Goldman Sachs say that equities, hedge funds have been sellers for 8 weeks in a row, and they've been selling U.S. equities. Two-year yields, curb your enthusiasm. We wait counting down to CPI. The market retraces on jumbo rate cut bets. And Eurodollar, 110.38, as Morgan Stanley talk about a 7% drop by the end of the year. Why? Because the ECB will cut by almost 110 basis points, way over where the market estimates at the moment. And there's the print on Apple, 1.25% lower on the back of that ruling in the EU. We'll talk more about that in a moment. Our guest this morning is Ella Hoxha, head of fixed income over at Newton Investment Management. She weighs in on the markets writing this: we remain on the conservative camp with regards to the risk in markets and are positioned thus. The core vector driving the view has been the odds of a weaker cyclical backdrop ahead of us over the next 6 to 12 months. Ella, good morning. Good to see you. To be conservative about risk, can you just expand on that? What does that actually mean?
Well, for us, effectively, it means that the risks of potentially bigger cuts on interest rates, a weaker cyclical backdrop, potentially even wider credit spreads, and weaker commodity currencies or emerging market currencies is the better expression of that view. So conservative position means we have low exposure to some of those vectors and more exposure to higher interest rate sensitivity, or duration, as we call it in bond land.
What do wider spreads look like in credit, Ella, where you see issuance continue at a record pace? You see demand for that issuance, no signs of abating. What does it look like when it turns?
We got a mini episode, I think, at the end of July and August. So we saw crossover spreads, so a measure or a gauge of that sensitivity, or spreads on investment grade credit, spreads on high yield particularly. So they widened, but it was very short-lived. So it was speedy, but very short-lived. And then we went back to this buy the dip mentality, and spreads tightened into September. So I think that mini episode, if validated as a view in terms of a weaker cyclical backdrop, then those spreads would widen significantly from here. So that would be the anticipation.
So then do you double down on core treasuries? As HSBC said to us yesterday, it's no time to pull out of your bullish position on bonds.
We have been adding actually as of Friday, so we've been managing the position side on duration, particularly given the big moves we had in July and August. And now we've actually come back to increase exposures. Funny enough, treasuries, yes, is one place, but we added further to our long end of Japan position. We've discussed that here in the show a couple of months ago. So I think that looks good as a position for us. It has a lot of convexity, and it's the steepest curve in G10. So it was a better, more efficient way to increase some duration risk to a global portfolio.
So, Ella, as you shift to a more defensive type portfolio, what's driving that? Sure, the labor market trends are one of weakening, but GDP continues to come in strong. Corporate earnings are staying afloat, and we got consumer spending and consumer credit data yesterday that showed that the U.S. consumer credit released the strongest monthly rise since October of 2022. What are the red flags you see in this economy?
For us, jobs has been the first one, and particularly so things like quits ratio, job openings, so this hiring confidence type indicators. Why? Because they're far more forward-looking, and we're in markets we're supposed to be forward-looking. A lot of the indicators that we're highlighting here, basically on the GDP side, tend to be more coincident in nature, so they're not telling you a lot about what's coming down the road. Now, I cannot say this is a 100% confidence view, right? Because we don't have a crystal ball, and it's very difficult difficult to foresee macro, in my opinion. But the odds certainly are that what the jobs market is telling you is that things might be weakening a lot further down the road. And so given particularly where valuations have been, especially if you started back in April and May, the odds were in your favor to sort of start positioning for that view. And we tend to think a lot more probabilistically in that sense. So jobs are what's concerning us, low level of savings for consumers in the US, consumer confidence. Those are probably some of the vectors, but also the manufacturing sector, which tends to lead the services sector, is also very weak in the US. So I think there's enough there to sort of, relative to valuations in markets, to get you concerned from a portfolio management perspective.
Is this part of the reason why you want to add to the dollar? Look at Morgan Stanley's call this morning. They're talking about 102 on the euro dollar, and that's predicated on 110 basis points of cuts. What's your view or the rationale for adding to the dollar?
Well, we initially started to add further to the yen positions because that seems like a bit of a cop-out, if you like. So, and we've been more contrarian on the yen angle. We've spoken here before. Dollar more in the predicament that if we have a weaker cyclical backdrop, you go back to that famous dollar smile, rather than actually we're going to get less cuts from the Fed. So that's the view that's driving that. On recession, the dollar tends to do well just because it's a risk-off metric. But I will concede, I don't have a lot of confidence in the dollar here, particularly because we have an election, and perhaps a Trump win could set up a very different position for the dollar. So we will need to be a bit more reactive. So here, a little bit long of the dollar, I would say. Probably the long yen dominates our FX positioning. But let's see, with the dollar, I'm a little bit more iffy, I probably would say at this point. But, you know, gun to my head, I would say still long dollars.
Well, you got a nice risk event to watch out for that tonight with today's debate. Ella, we appreciate your time this morning. Ella Hoxha of Newton Investment Management. Manus, let's get to some other top stories that are trending on the terminal this morning. The biggest U.S. banks will see a 9% increase in capital requirements. That is a dramatic retreat from the 19% that regulators had previous plans. The reductions are more likely to appease the biggest 8 U.S. banks that the requirement covers. Banks had fiercely lobbied against the original proposals.
Goldman's trading unit is on track to drop 10% from the prior year, led by a decline in the fixed income business. That's according to the CEO, David Solomon. He also disclosed this at a Barclays conference yesterday, that the bank will take a $400 million pre-tax hit in its narrowing consumer business as it moves away from its credit card tie-up with General Motors.
The U.S. House of Representatives passed legislation last night to blacklist Chinese biotech companies and their U.S. subsidiaries. The bill's backers argue that the law addresses concerns over security. Those concerns were denied by 2 Chinese biotech companies. They said that they don't pose a security risk to the U.S. or any other nation. The bill now goes to the Senate. It's your Bloomberg Brief. I'm Danny Berger, alongside Manus Cranny in New York. Let's head over to Paris at the EPEM conference, where Bloomberg's Kriti Gupta is standing by with a top voice on the ground in growth equity and private equity. Kriti.
Danny, thank you so much. As you said, we are in Paris. There's a lot of conversation about where these European markets are looking at. You know this best, this idea that there's so much capital wrapped up in the private markets right now. We're waiting for it to be deployed into the public ones. What does that timeline look like? And does it differ from what you see over in the States versus Europe? We have a perfect voice, as you said. Gabriel Caillaux over at General Atlantic, the co-president there, joins me here in Paris. Pleasure to have you on the program. Thank you so much for joining us. Let's start there. The European investment story, the timeline for this deal making and this kind of return to shareholders. What does that time horizon look like for you?
Yeah. You know, the markets we've always worked in are the innovation markets. And so it's interesting. There's always a perception that Europe lags other markets in terms of innovation, technology, and so on. And the truth is, what we've seen is over longer periods of time, it's always somewhere about 25% of what we find is European deals. And the private markets are actually quite efficient. So I think right now there's a lot of talk of, is innovation capital getting to the right entrepreneurs? Are we giving the right access to capital for growth and for sustained growth? We think that's happening. I think there's a broader discussion that's happening right now, which is in the continuum of a life cycle of capital, from the angel investor to the venture capitalist to growth equity like what we do, to then later stage buyout in the public markets. Is there some breakage there where you're not seeing capital flow efficiently to the right companies? And I think that's something we do worry about.
Gabe, Danny here in New York. Really great to see you again. We are seeing in sort of your sort of stage of capital, people like Sequoia facing this pressure to return money to shareholders and doing things like selling themselves their own assets to different funds. Is that still the number one concerns for your investors, your LPs, getting cash back to them?
Yeah, it's a balance. So it's a good point, Danny, and good to hear from you again. It is a question. You have a lot of LPs. You've seen private markets continue to grow, right? So in a way, and I think that's a natural thing that's going to keep happening, is for many parts of the market, actually private capital is a better product for entrepreneurs than the public capital. But what's happened as a result is we've dragged on a lot of commitments from our investors. Certain investors feel overexposed, and they're asking for investors like us to return capital. I think this is all starting to unwind really naturally. We see it in our own portfolio. Over long periods of time, we've always returned more capital than we've deployed for our investors. That wasn't the case in 22 and 23 when markets were completely dislocated, right? Public markets were shut for capital formation. Private markets were very volatile. Debt markets were dealing with rate rises. That's starting to unfold a little bit into a positive momentum, and we see that in our portfolio. So I think it's going to settle itself out. We certainly don't think it ever justifies doing anything that's unnatural, either for our portfolio companies, our investors, or ourselves. So this idea of selling to yourself, this idea of leveraging your portfolio to take liquidity out, we don't think that's real de-risking. We just think you have to build great companies, and liquidity kind of sorts itself out as markets find stability again.
Gabe, you've mentioned entrepreneurs a few times. What do the headwinds look like in a regulatory environment, both in Europe and the U.S., where you see regulators cracking down a lot more specifically on tech, something General Atlantic does so much of? Are you concerned that it's hamstringing not just your ability to do deals, but the entrepreneurial environment in general?
I'll tell you, Dana, it's something we worry about all the time. And actually, if you take a longer view of what's happened recently, there's been challenge after challenge to innovation and entrepreneurship, right? Whether it's the China plus one or China decoupling, whatever you want to call it, whether it's tougher antitrust position that rule mergers, whether it's harder access to capital, whether it's it becomes more and more expensive to grow internationally. I mean, all those things are things that we've seen happen in our portfolio, and our portfolio is very global, so we have a good feel for what's happening in each of these markets. But I'll tell you, the reassuring thing is, despite all of that noise, despite the geopolitical risk, despite all the bad things happening, we have seen almost no slowdown in company formation, innovation, almost no slowdown in the growth rate of our own portfolio, right? Our portfolio is a $60 billion portfolio. Right now, it's growing in the mid-30s. So you can see the type of growth at scale that's still happening in innovative and technology markets. And it seems like it's really the disruptive nature of the portfolio is winning over all the short-term noise that's created by some of these headwinds. So we keep a pretty optimistic perspective on it. It's backed by the data in our portfolio, but it's certainly something that, if I think 10 years ago, it has become harder to build a global champion. It has become harder to grow internationally, and that's a shame.
Let's bring it right back to the capital markets, and I think it's where we started our conversation here. What's the benefit of being a public company right now? What's the point of IPOing if you can get these yields elsewhere?
I'm obviously biased in my answer because I'm the private capital person here, but forever, and I think if you'd interviewed me 10 years ago, I would have told you that there was still a real perception in an entrepreneur's mind that when you list your company into the public markets, that gives it longevity. It gives it access to capital. It means it'll survive forever. And it gave you a way of continuing to grow your business. I think that's what's really changed right now in the eyes of most entrepreneurs, and not in the eyes of private investors. I want the public markets to function and be open, right? It's a fantastic tool for capital raising and capital formation. It's really the eyes of the entrepreneur. The entrepreneur looks back at what's happened the last few years, and there's too many carcasses on the side of the road of the IPO markets. And IPO markets in our markets, so in the growth segments, they become really fickle, right? You have a bad quarter, you're given up on. If you're subscale, you're given up on. And oftentimes, if you want to invest in a 5-year growth strategy, public markets don't have the patience for that. So I think it's a moment in time kind of thing that we need to fix. In the meantime, I think it's great for private capital because we're stepping into that void, and it's providing huge investment opportunity, and probably one of the best I've seen in my career, frankly. But we need capital markets, the IPO markets, to come back. All
right. Gabriel Caillaux, of course, the co-president over of General Atlantic, joining us live from EPEN in Paris. Got plenty more coming up with Manus and Danny. Stick with us. This is Bloomberg.
It's Bloomberg Brief. One welcome back. We're just counting down to the launch of Falcon 9 Polaris Dawn. We're going to take you through that launch in a little while. There is the launch pad. It is Falcon 9 Polaris Dawn. Lots of delays before we got to this. The weather interrupted the earlier takeoff. We'll count you down to that launch in just a few minutes. Let's stay with tech and the broader theme. We've got Apple and Google. They've lost their respective legal cases in the European Union's top court, putting them on the hook for billions of euros of fine. Matt Bloxham is with us from Bloomberg Intelligence. Matt, when we talk about the Apple fine, we must put it in context. This has been dragging on since 2016. It's around Irish taxation, and it's the equivalent of 2/4 of Mac sales. Put the context around this. This is more about messaging than dollars.
Yeah, that's right. It's been a long time coming, and obviously they won't like the outcome. But yeah, you know, lots has happened since then, and particularly in the last couple of years with the European Union launching things like the Digital Markets Act and the Digital Services Act, which are meant to be more robust, sustainable, effective ways to police the big tech companies like Google and Apple. So I think perhaps those cases were like kind of precursors to what we've seen in the more recent times, and it's those things like the Digital Markets Act which I think are more significant in terms of how companies like Apple and Google are going to be able to operate going forward.
Matt, we're still looking at live pictures of Cape Canaveral of the SpaceX launch of Polaris Dawn. You can see the countdown clock there, less than 3 minutes to go. This will be the furthest that we have traveled in space, save for a moonwalk in the past 50 years since the Apollo launch. What is the hope in accomplishing this for SpaceX?
Yeah, I mean, this is a very significant mission in many ways. Obviously, it's a commercial mission, not a space agency mission, so that in itself is significant and shows you just what's happened to the costs of putting people into space. As you say, that this kind of orbit's going to be, I think, 3 times the height of the International Space Station, so at about 870 miles. There's quite a few significant things that are going to happen with this, which are of importance for the kind of longer-term space exploration project that we're looking at. And one of those is that the astronauts will do this spacewalk, or at least attempt to spacewalk out of the capsule, and they will test these new EVA suits that SpaceX has been developing, and that those suits are really significant in terms of future plans to build a base on the moon and potentially a base on Mars. So you need to kind of understand that this technology works and can be developed at scale at a cost-effective price. And there's going to be lots of other experiments they do whilst they're up there, particularly understanding how the human body responds to long-duration space flights, which are going to be obviously very significant if we do ever see trips, particularly out to Mars. So lots of significant things going on with this mission.
How significant is this, Matt? We've got Jared Isaacman on board. He'd be one of the people that's doing a spacewalk along with Ms. Gillis. How important is this for the evolution of the private part of space travel?
I mean, this is a very well-funded mission, but it is important. I think that what we're starting to see, whereas people used to think that being an astronaut was
hey, Matt,
the domain
can you actually hold that thought for just a second? Because we're getting down to 30 seconds away from this launch, and we want to listen in as they do that. Again, this is the Polaris Dawn. It will take people farther from the Earth than any time in the past 50 years. Let's go ahead and listen in.
T-minus 15. T-minus 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Ignition. Copy, 1 Alpha. Vehicle switching downrange. Propulsion is nominal.
T plus 35 seconds into the Polaris Dawn mission. flying crew on board Dragon and Falcon 9 to new heights.
Power and telemetry nominal.
And we're throttling down in preparation for max Q. Next call out, vehicle supersonic. And there on the left side, we've got the Polaris Dawn crew.
Supersonic.
Thumbs up from the pilot on the left side there.
Max Q.
We're throttling back up to power.
1 Bravo.
And we heard the call out, 1 Bravo.
Copy, 1 Bravo.
That just tells the crew what would happen should they need to initiate anything. But right now, everybody making nominal call-outs on Falcon 9. Nice views from the ground camera, and nice views from inside Dragon.
MVAC chill is underway.
The announcement lets us know we've begun the final chill of the second stage engine, preparation for its activity coming up at about T plus 2 minutes and 40 seconds. Into flight. Everything continues to look good. We'll have in half a minute 3 major activities. Shut down of the 9 Merlin 1D engines, stage separation,
Throttle down.
and then ignition of the second stage engine. Throttle down, we're holding a constant acceleration now for the crew just below 4 Gs. See, we're coming up 70 kilometers. For MECO.
Main engine cut off.
Have seen is the rocket travel through maximum dynamic pressure, also known as max Q. What you just saw was a separation after the main engine cut off. It's the second engine burning, the second engine starts 1, and then they start to reach the injection orbit. Overall, this will go 118 miles above Earth, swing to an altitude of 745 miles. The furthest point, once it goes through its orbit, will be 870 miles. So we're again looking at images of the separation just happening. Let's bring in Matt Bloxham, who we've been talking to about this SpaceX launch while we leave those pictures up there and look at this incredible journey. Matt, before I interrupted you for this launch, you were just talking about some of the people behind this mission. Manus mentioned Jarek Isaacman. Just pick us up from where you last left off.
Yeah, you know, you were talking about the significance of this to like kind of the private space industry, and I think it is really significant in a number of ways. One, you know, I think I think a lot of people have this perception that being an astronaut, you have to be like an experienced kind of probably coming from the military. And if we're really going to see space being a significant part of the kind of human experience, then it's going to have to be open up to people from all walks of life. And I think what we're seeing with this mission and with lots of similar missions we've seen in the last couple of years, that actually, you know, it is possible to train people to be astronauts and put them up in space and to do it cost effectively. And I think obviously we've seen over the last couple of decades that the traditional domain of the national government, space agencies really being the big pioneers of space exploration and innovation has come to an end, and they don't have the money to do it anymore, and that you do need the private capital, the private sector to kind of step in and take things forward, and that's exactly what we're seeing today. And I think you'll start to see even like NASA benefit from some of the expertise and experience we developed from this mission into some of their planned missions to the moon and beyond. So it really is quite a significant step forward.
Well, we're just keeping an eye on that capsule. I mean, they'll travel at 17,000 miles per hour during this journey. Matt, the other aspect this week was the Boeing Starliner returning to Earth without a crew, but safely. And again, this was an important milestone for Boeing in this commercial space.
Yeah. Well, I mean, it's good to see that come back without any incremental hiccups. Obviously, it's still clearly a bit of a niggle for Boeing, the kind of second of NASA's chosen partners to kind of take crews to the International Space Station and then ultimately beyond to the moon. And so, I think to some degree, these setbacks for Boeing put SpaceX even more in the ascendancy in terms of what they can do both in the private sector and for NASA. And obviously the Crew Dragon capsule we're seeing today is exactly the kind of capsule that they use to take astronauts to and from the International Space Station. So yeah, good to see that Boeing got that vehicle back to Earth safely. But I think a lot of work for them to do to understand what went wrong and why the astronauts that were meant to be spending just a few days up at the ISS are going to be there into next year.
Well, we'll leave our audience with an image there of Falcon 9 Polaris Dawn. Matt Bloxham taking us through the tech stories of the day. Of course, that same capsule went to the International Space Station in 2020. We'll track the journey through the morning. Markets are moving. We've got a couple of tech stocks in focus. But Danny, that buy the dip moment didn't last for very long yesterday, did it?
It didn't, and perhaps it's because it was built on, I don't know, nothing, just sentiment at least. That's how Jim Reed puts it. It is sentiment that drove yesterday's buy the dip, not new data. So in the meantime, S&P futures weaker by 0.2%. Tech underperforms, as you mentioned, Manus, with tax deals and bills being shut down by the European courts. Meanwhile, 10-year yields, little change this morning, 3.7%. They did fall to the lowest since June 2023 yesterday. 30% odds of a 50 basis point cut is where we stand. Brent crude continues to fall, down by 1 1/3. It is near the lowest level in 3 years. So in trying to understand where equities go from this and the very downward trading they've been having, Amy Silverman of RBC Capital Markets writes this. Equities caught up with the less sanguine view of other markets, option markets, and on the other hand, option markets have remained fairly bearish since the early August volatility spike. And as we continue to look at pictures of a rocket, we're going to talk to Amy Wu Silverman now. Amy, perhaps we can use this rocket as, I don't know, a metaphor for the bearishness taking off for this equity market. But after the bearishness that we've seen, the worst week for equities since the SVB crisis, have things now matched the more bearish underlying options? Do things look to be more right-sized?
I think a little bit at least, but, I don't know that we're quite there yet. It's just been very interesting to me because after that big August drawdown we had, options didn't ever quite right size. And to me, that was a huge inflection point because I know the last few times we've spoken, we've actually talked about the unbelievable exuberance in options that we saw the first half of this year where, there was just historic call buying. A lot of that has been sucked out of the market and unfortunately been replaced by this bearish sentiment we see in put options.
Amy, good morning. Yep, we've got SpaceX taking off. You talk about the airplane's altitude has stabilized, but the passengers have not forgotten the turbulence of August. There you see, we got it in. The question then is whether are we actively hedging at the moment or are we trimming risk? Because they're two very different things.
That's exactly right. They are two completely different things. And what I'll tell you is that there is active hedging going on. There's been a pickup in interest. Now, look, when we kind of go back historically, 5 years, 10 years, 20 years, Manus, we're still not at peaks that we've seen before. But given just how much this market had been focused on the FOMO and the MOMO, it's still very interesting because the fact that we even have this interest at all is something to write home about. One thing I've been saying since, maybe March or April is how can we have the S&P at these historic levels and just no interest in any sort of hedging, especially just given positioning, right? When you want to protect your portfolio, that conversation has finally started to change. We are seeing that demand for hedging. And frankly, a lot of trades also saying that there's limited upside going into the end of the year.
Yeah. Sorry, I just to point out, because there's literally cheering next to you, Amy, while you're talking. The stage 1 vehicle has touched down after separation. Just they are also cheering probably about what Amy is saying, but that's what you're looking at right now when it comes to SpaceX. It is that separation, the stage 1 vehicle touching back down. Amy, back to the picture of volatility. We get a debate tonight. It is closer to the presidential election. How are volatility markets set up for it?
I think we should be watching this very closely. Look, there's certainly a hump in the tenors when you look at November 5th pricing, so the actual date of the U.S. elections. And, the one thing I'll say is the only precedent we've had this year is the fact that we actually changed the Democratic candidate at the last presidential debate, right? And now we were very close in terms of what the polls are saying for Trump and Harris. And so this will be a key to watch. There's obviously a lot of policy implications that come from it. But, a secondary fact we've been talking about is just this idea of if the election is contested at all, if it is close at all, and we don't have certainty of who the winner is, I think that's something that really can trigger more volatility in the markets.
You just got to go back to that January 6th event. In 2020, 147 Republicans voted to overturn the election. Where is the go-to hedge in that intervening period? Where do you think the market will lean into for a hedge, Amy?
Look, I think it'll go kind of the traditional route. So your S&P put options, your VIX call options, certainly you could see it on a sector by sector basis. But, in times of really crucial uncertainty, the market goes back to its old playbook, which is always these index level volatility hedges that we hadn't seen at all during the beginning half of this year. But again, unfortunately has become more of the case that these ideas of a contested election is something that we have to consider as a tail event. And if that does happen, we've seen VIX go back to the 40 and 50s.
So that's one of the risks, Amy, but it seems elsewhere in this market there is a lot of sanguine attitudes about what equity markets do from here. I'm specifically thinking of forward projections for margins in the S&P 500. They're approaching an all-time high. 13.6% is the projection for this time next year for margins for this equity market. That's a whole percentage point more than we are right now. If you look at the analyst community out there and you contrast that with what option markets are telling you, is there still some of that needs to be shaken out? Or are we too positive in what corporations can do a year out as we're also debating slowing jobs markets and the potential for a recession?
It's such a great question. And one thing I actually like to do, too, is to look at what the analyst community is saying. And I sort of back solve that. So if you actually just take average analyst price targets and aggregate them up from the S&P 500 level, you can get a pretty good idea of what the Sharpe ratios are for the S&P by sector, right? And that's taking into account the expected returns and the volatility we see going forward. I will tell you that most of the upside in the market essentially looks fairly limited. And then the second thing I'd say is all these Sharpe ratios are declining sector by sector. And so I think when the options market is telling you we're selling volatility to the upside to buy volatility on the downside, it's reflective of that idea that we already see in these Sharpe ratios.
You say that the market no longer has a FOMO for AI stocks. What is the consequence of that? Does it bear on rotation?
Yeah, I think the consequences here are huge. And I know people love to get really excited about rotation. Look, I'm excited too. But the problem is the math of the market. As long as we have this heavyweight breadth problem, even if we get a great rotation, even if we get more hands and breadth, we're not going to solve the problem of the market going down if AI is going down. That's fundamentally the issue. You can highly see that correlated to S&P moves and just NVIDIA moves when they have their shout dart tones. So you kind of need to have both working, or at least one being okay. And that's the situation that I think we're most concerned about.
Okay, Amy, Wu Silverman, thank you very much. No more fear of the AI trade. You're still looking at a shot of Falcon 9's Polaris Dawn, which took off several minutes ago. There have been a number of delays in this, but it's gone perfectly smoothly. We're just counting down to the next event in this sequence, which is where Dragon will detach from there's a separation that will take place in about 2 minutes. Let's get back to Matt Bloxham. He's with us for this journey, the takeoff. It's gone seamlessly so far. There have been a number of moments in the lead up to this launch where the regulators briefly stopped Falcon 9 rockets from flying. So what kind of changes had to be made to make this event come to pass, Matt?
Yeah, I mean, there's always kind of issues about SpaceX launches and the kind of environmental impact that they can sometimes have. So that we've seen that time after time, and particularly with the new Starship that they're testing right now. So that it's a kind of sensitive interplay between government agencies and SpaceX and other rocket launch businesses. But I think beyond that, there's just all sorts of other issues that come into play. There's just the rockets are incredibly sensitive, so I think that they also had some kind of technical issues with some leaks. And also the weather plays a massive part in it. We've seen that today, that this launch has been delayed by an hour or so, and it's not just having the right conditions for the actual takeoff, but you need the right conditions or confidence that the conditions will be okay 5 or 6 days out for when they do the splashdown of the crew capsule. So there's a lot of different factors that can come into play when you're trying to get people and machines into orbit.
Yeah, and can I just say, at the moment we're looking at some of that orbit, and the pictures are absolutely beautiful of the Polaris Dawn orbiting over the Earth, going towards the sun. Matt, you mentioned this idea that they need to have good weather to land, and there's a limited amount of supplies that they have. What sort of backups? I mean, we learned from what happened with the Boeing Starliner that things can go wrong, and SpaceX has to come save the day. How do these things work in terms of making sure that they are able to get back to the ground okay in the allotted time that they've given themselves?
Yeah, I mean, I think the reality is, for a small capsule like this, there aren't many backups, and that you just have to kind of do the best you can to judge it. Obviously, even predicting the weather 5 or 6 days out is an art as much as a science, I think. So I think ultimately maybe they could kind of keep them orbiting for a little bit longer, but they just have to suck it up and maybe give them a more than expected uncomfortable landing. When push comes to shove, it's a little bit different when you've got people on the International Space Station, where there's clearly a lot more backup supplies there to kind of keep people going for months. But yeah, ultimately they don't have a huge amount of flexibility in when they bring these people back.
Certainly, and I guess that accounts for some of the delays, making sure that the weather from 6 days from now is good too. Matt, we really appreciate you walking us through the SpaceX Polaris Dawn launch. That's Matt Bloxham there, and we'll leave you with these beautiful pictures as they orbit the Earth.
It is Bloomberg Brief. I'm Manus Cranny alongside Danny Berger here in New York. It is the biggest U.S. banks. They're going to face a 9% capital increase requirement after the regulators agreed to sweeping changes of a proposed package of rules. Now, the dramatic retreat comes after the banks fiercely lobbied against the initial proposals of 19%. For more on the story, we have our managing editor for EMEA Finance, Tom Metcalf. So, Tom, this is quite a significant step back from the 19% to a much, much lower level. What does it mean for the banks? I mean, this is quite a U-turn. What does it mean for capital? What does it mean for dividends and buybacks, probably? This goes through my head, first of all, this morning.
Of course it is, Manus. Yeah, no, it's a pretty good result for the banks just on the face of it, right? 19% down to 9% or so. And, obviously everything's still up for grabs. But I think just the fact, wow, that's a complete halving of the initial proposal. That shows, A, how strongly the banks were lobbying, and B, just, the shift in tides on all these things as well. So I think you're dead on, what does this mean longer term? Better news for the size of buybacks and, dividends perhaps. But I actually think there's still probably a way to go before the final sort of outline of this comes through, because I'm sure the banks, while they'll be celebrating, might also be going, well, if we manage to get halfway, maybe if we can stick together on this, continue lobbying, is there sort of more kind of, sort of more softening to come?
Interesting. Well, for Goldman, they have other things to deal with. And Solomon was at the Barclays conference yesterday talking about a 10% drop from the prior years, what they expect in the bank's trading unit. Tom, I thought this was supposed to be a period of volatility and riches and everyone for trading. Is it just the wrong kind of volatility?
Yeah, it's a bit of a muted tone, right? I mean, analysts were expecting Goldman's traders to drop about 7%. So, this is in the third quarter. So 10% is just showing, hey, it's even worse than they were thinking. I think one of the things we should remember is the prior period that they're comparing to was very strong, and that's what Solomon was really hitting. But yeah, no, there is a sense that, sort of the fat years might well be behind them, or the fat quarters, I suppose. And it'll be really interesting this third quarter, actually. And you've got more executives coming through this Barclays conference. So I'm very curious to see if that's sort of the general tone that sort of flows out of that meeting.
We look forward to your coverage of it. Tom, thanks so much. Bloomberg's Tom Metcalf From banks to tech, Apple and Google have lost their cases in the European Union's top court. It puts them on the hook for billions of euros in fines. Let's get back to Matt Bloxham of Bloomberg Intelligence. Matt, great to catch up with you again. What is the big takeaway from this? We know the EU has been more tough on tech rulings and things like antitrust. What does this turn do?
Yeah, I mean, so we have to remember that these cases kind of go back 7 or 8 years, and so these are almost like a kind of precursor to the much more kind of significant regulatory action we've seen from the EU against big tech in the last couple of years, notably through the Digital Markets Act, which has really tried to kind of identify these companies as gatekeepers and put into legislation much clearer do's and don'ts about what they're allowed to do, and particularly the kind of Google case, which is about them kind of favouring their own shopping platform, really plays to the heart of that. So I think, you know, it's been a long time to kind of get these cases finally over the line. I think that's not been good for you know, business or the EU in terms of kind of policing the industry, and so I think the evolution towards the Digital Markets Act is aimed to kind of set out the rules of the road much more clearly and to give the European Commission the kind of tools to effectively police the industry in an effective and in a quicker way, so that you can kind of bring issues to bear much more quickly and move on and change behaviour much more quickly.
Again, it just sort of divides the landscape between the innovation of the US and the regulation in the EU, and what happens next with AI. Matt, thank you very much. Covering the details there. Matt Bloxham on the technology stories this morning. Context matters on Bloomberg. We're just 8 weeks away from the US presidential election. The former President Trump and Vice President Harris are gearing up for the first debate in Philadelphia tonight. The state of Pennsylvania is a crucial swing state for the candidates, and it's our first episode of the Election Brief. We dig into the deeper issues that matter the most in the Keystone State, and one of those is voter turnout, fracking, and the economy. Joining us now from Washington is our Bloomberg Real Economy reporter, Mark Niket. Mark, the road to the White House, we understand, it's very clear. Without Pennsylvania, it's virtually impossible. In terms of what they've got to do in Pennsylvania, it is about the voter turnout, and it's specifically around some of the bigger cities in the state, isn't it?
Right. If you're a Democrat and you want to win Pennsylvania, you need to have a big voter turnout in Philadelphia and the suburban counties surrounding Philadelphia, and in Allegheny County, which is Pittsburgh. Joe Biden got about 30% of his vote out of those two counties alone, because the rest of the state, for the large part, is Republican. There's huge swaths of Pennsylvania, the center of Pennsylvania, and areas around the urban centers that are just solidly Republican. So it becomes a question of math, and can Democrats get enough votes out of the urban areas to overcome the Republican votes that are going to be cast for Trump in the rest of the state?
That's the math. What about what they need to say to make that math reality? We're going to hear from both the candidates tonight in the first and likely, at the moment, the only debate between the two of them, between Harris and Trump. What is the language and type of policy that targets Pennsylvania specifically?
A lot of it's going to be on the economy, frankly. The economy, like in a lot of states, swing states, is the top issues. Polls say voters believe the economy is going to decide the election. And in Pennsylvania, fracking is a particularly important economic issue because Pennsylvania is the second leading producer of natural gas in the country besides Texas. And fracking played an important role in the presidential primaries in 2020 when Kamala Harris was running for president. She flat out declared that she would ban fracking if she were elected because this was a Democratic primary, and the liberal position on fracking was to ban it at that point. Well, fast forward to 2024, now that Kamala Harris is the nominee, replacing Joe Biden on the ticket. She's saying she does not support banning fracking. And fracking is a huge issue, like I said, in Pennsylvania because of the number of jobs and revenue that come into the Commonwealth because of fracking. And Donald Trump and Republicans have really tried to hit Kamala Harris on her past position on fracking, saying she would ban fracking, and essentially you can't trust her not to oppose fracking if she were elected.
Mark, one thing that we learned in the recent polls is the public want to know more about Harris. They know enough about Trump. What has she got to do this evening to convince those undecided voters that she is something perhaps different to Biden, because Trump still leads on the economic states? How does she differentiate herself to Biden?
I think she has to show competency, frankly. She's been vice president, but I think a lot of voters maybe don't know a lot about her, or certainly don't know as much about her as they did Biden and Trump. So, you know, this debate tonight gives her an opportunity to show that contrast with former President Trump and show that she's up for the job, frankly. I think a lot of people are going to be tuning in to hear not only what she says, but how she says it and how she appears. Does she appear presidential? And is she able to sort of, you know, put Trump in his place, as it were?
Okay, we'll see what tonight brings. That is Bloomberg's Mark Niquette. Thank you so much for that, Mark. Don't miss our special coverage of the debate that starts at 8 p.m. Eastern right here on Bloomberg. It's a blackout period for the Fed. We wait for CPI, so all we have, Manus, in the meantime is this debate to trade on.
I think it's pretty significant. You know, it's one of the only moments in time where you're going to see these two candidates on the same space at the same time. Even though the mics are down, that doesn't mean it can't get ruffled.